Morning everyone. I am Dr. Manoj Kumar NV, Associate Professor in the Department of Management Sciences, Maharaja Institute of Technology, Mysore. So in the previous session, we have discussed about what are all the major banking reforms and how it is important for the banking sector towards know their rules, procedure and regulations. So today we are focusing on the bank performance analysis. So as we know that whenever we do the performance analysis, there should be a consideration of the size of the banks and their efficiency and their liquidity, solvency level and the profitability concern. So therefore, in today's we are focusing on the banking financial performance analysis, where as you know the subject title banking and financial services, subject code is 18 MBA FM 301. So in that today we are discussing the banker performance analysis as a session 8. So when we considering a financial performance, it is most important for every banker to know what's their level of performance, what's the growth of the particular bank. These are with respect to it, we can able to say that we can match our performance with the other banks or other country banks with respect to whatever the achieved performance as an individual banker. So the financial performance means where some of the key financial ratios investors use to analyze the bank performance includes return on equity, or we call it as return on net worth, and return on assets, efficiency ratio, net interest margin. These are the specific ratios which is measure the banker performance. Even as an investor, they are going to concentrate on these kind of the ratios while they are going to measuring the performance of the banker. So first we can take an example of return on equity. We also call it as return on net worth. So return on equity, which is measures that what is the contribution of the returns with respect to the equity investment. As you know, equity is a pure investment of the banker and it is raised to share capital or preference share capital or reserves and surplus. So therefore, the insiders funds, whatever we had insiders funds in the banks, that is going to be known that what will be the return which is associated for the particular investment as a return on equity. Then the return on assets. So we had a various types of assets in the banks where we have a fixed assets, we have a current assets, we also have a intangible assets. So where we are going to get to know how these assets are contributing, what is the return on the particular assets. That is also one of the measuring tools to the banker to know about the particular performance. Then coming to the efficiency ratio, the efficiency ratio which is measure the performance, we also call it as performance ratio, or we also call it as activity ratio. How many times the banker is going to perform, what is the collection period, what is the payment period. These are sort of the efficiency which is going to be measured in terms of efficiency ratio. Then coming to the next one, where we are concentrating on net interest margin. So this is the most important thing, where we are going to be ascertain the interest payment and interest received. So therefore, based on that, we are going to be have a banker spread. So therefore, these are the major 4 financial ratios which are help to the banker to evaluate himself as well as the investor, they are going to be focused on the particular bank performance by considering this sort of ratios. Then coming to the particular ratio, we can say that it is also to help or to compare financial performance with competitors. So means when the bankers facing a competition, obviously they must need to compare these ratios with their competitors. So therefore it will be helpful to them to make right decisions and right policy, procedure and norms they can able to state with respect to increasing the overall efficiency. So the efficiency ratio is a measure of non-interest relative income, and a lower efficiency indicates stronger performance. So the Foreign Direct Investment Corporation's website is user friendly, allowing you to download the financial data for specific banks and their peers. So therefore you can able to get to know how the banker performance is. Just visit FDIC website, so where you can able to ascertain how the banker performance is, how these key result ratios are most important, and how the bankers or competitors, they are going to be consider this ratio as a major influencing factors for evaluating the individual performance. Then coming to the loan portfolio. So most banks derive the bulk of their income from their loan portfolios. So means banker always receive the interest when they are ready to provide more loans. So this makes a growth and the composition of a bank loan portfolio an important metric for analysis. So means unless the banker, they are not ready to provide the loans, just they are accepting the deposit, then the performance of the banker become poorer, because they are not in the position to pay the interest for the depositors unless they are given a right way of providing the loans. So the notes to a financial statement contains a breakdown of the bank's loan portfolio between residential mortgage, industrial mortgage, commercial mortgage, automotive mortgage, installment mortgage and miscellaneous loans. So therefore, whenever they do plan for loan portfolio, every banker, they must need to be planned properly with respect to how much they must need to be keep the loan for the different portfolio segment. So here we are taken the loan for the self or commercial purpose or automotive for installment or miscellaneous loans. All these loans, sometimes there will be a chance of there is a bank which is situated in urban area where they are mainly focusing on home loan, or it might be a vehicle loan they are going to be concentrate. If the same bank which is situated in the rural area where they are going to be mainly concentrate on agricultural loan, educational loan. So these sort of the differentiation will be there based on the different segmentation. So therefore, as a banker, they must need to be know how they are going to plan towards considering a different loan purpose of different loans for serving all the required expectation of the customer. So therefore, the loan portfolio, that is most important thing for the banker to deciding out to providing a loan of 100%, whatever they accept the deposit, out of it they keep the SLR and CRR, and the remaining value or remaining amount they are going to provide it as loans. So it is also considered the loan growth and differentiate between the organic growth and loan generated by the new branches. So organic growth means the firm itself, they are increasing the capital base. When they increasing the capital base, the banks have a capacity to give more loans, or else the second way is they are opening a new branch, so therefore new customers, new deposits, and whatever the deposit they are collected, they are going to issue direct as loan. So therefore they must need to concentrate on the two factors where it is from organic growth as well as from the new branches. Pay attention for any trends in uncollectible loans. An increase may indicate weakness in the bank's lending capabilities or economic environment. So uncollectible loans, that will be create more bad debts to the bank. When the bad debts proportion increase, the NPA, non-performing asset proportion, is rise for the bankers. When the NPA proportion is rise, capital adequacy become lower, profitability become lower. So therefore banker at the end, they are going to face the condition like bankruptcy or financial distress. So therefore proper planning towards the loan portfolio, that is one of the major decision by the banker. They must need to focus on each and every consideration and expectation of the investors to providing the proper loan services in the different segmented areas. Then coming to the capital adequacy. The capital adequacy, since the collapse of financial high profile banks, including the banks like as I said in the previous class, the American Bank, Lehman Brothers and Bear Stearns, the capital adequacy ratio reached very low. So though both the banks are considered under the bankruptcy. And capital adequacy has been a very hot topic with respect to considering those two banks. So therefore the banks must have a sufficient capital in order to absorb the losses. So means always the banks should have a high base of capital. Even though some losses are incurred, they must need to be cope up with whatever the capital base they have. They must need to be in the position to continue the banking operation rather than stop the operations. So therefore any banker, they must need to be maintain a capital, sufficient capital base in order to absorb the losses and any potential liquidity declines streaming from the customer withdrawing the funds. So therefore bankers were they should be very careful with respect to whenever they are claiming the amounts, they must need to be a limit for that. So therefore as we know that in each day operation SBI set 40,000 is the limit. If you are exceed more than that, they are not allowed. They kept holding the transaction till another 24 hours. So as same, if every investors, if they are withdraw the amount, obviously the adequacy, capital adequacy become lower. So therefore as a banker, they are not allowed for the investor to claim all withdrawal from their accounts. And bank with high risk tolerance are potentially at risk incurring losses, but also may violate regulatory requirements if insufficient funds are set aside as reserves. So therefore bankers should be very careful if they have a high risk tolerance level. If they have a high risk tolerance level, obviously they are in the potential at risk of incurring a losses. So therefore any violating of regulatory requirements if insufficient funds are set aside or as reserves. So therefore we should be very careful with respect to maintaining proper reserves. The reasons of banks do not maximize the reserves if they prefer to use the funds to generate the additional revenue. So as I said, bankers have an operation with respect to open market operations and all. If they are focusing on such area rather than keeping the reserves at the time, sometimes if they make huge losses, then it becomes very difficult to meet the liquidity. Whatever the deposit they received, they are not in the position to return it back. So therefore, as a banker, they must need to properly plan towards how much need to be kept it as reserve and how much they are going to be issued it as loan, and what is the amount which they are going to be invested in the somewhere else for the expected return. So therefore, this is the proper plan and execution which is required, and the consideration of different segments and capital adequacy is most important phenomenon for any banker. They must need to be considered this for the smooth flowing of operation. Then coming to the last point in the performance analysis, banker performance analysis, that is gap analysis. So the gap analysis is used to measure a bank's exposure. So bank exposure to interest rate risk. So as I said, interest rate which is fluctuate. As we know, the Indian interest rate is fluctuating interest rate. It is depends on the market scenario. If the inflation is high, there is a change in interest rate. If the market performance is good, then the interest rate may varies. If the banker rate were changes, the guidelines were changes, political influences happen, though these are the major influencing factors to expected change in interest rate. So therefore, to measure the bank exposure with respect to interest rate, that is one of the gap analysis. So therefore, every banker, they must need to be very careful regarding to the such announcement, such issues, such information with regarding to the changes in interest rate. So banks try to match the duration of their assets and liabilities. This way, when a certain amount must be paid to a customer, the bank will have a adequate cash in hand and will not to have to use the variable earnings assets to make the payment. So therefore, bankers should need to be properly maintain the adequate cash which is required to meet the customer expectation. So means if the customer, whatever the amount deposited, the banker must need to be in the position always to meet the whatever the responsibility or liability for the payment. So therefore, as the interest rate, the nature of the stream of payments changes, the degree to which there is an imbalance between the duration of assets and liabilities, which will dictate the magnitude of the effect. So therefore, the duration of the asset, which is always depends on how it is going to be influenced. So therefore, if the duration is long, then if proper adequacy is not met, then the financial health become poor. So therefore always as a banker, they must need to be consider the magnitude of the change or degree of change in the assets and liabilities. The duration need to be considered to maintain the bank's financial health. So then we are moving to future. We are moving to a future of banking, where we can see that where the banking, the first condition. So in future, in Indian banking sector has undergone a paradigm shift in the past 2 decades, evolving the physical banking to digital banking. So nowadays we can see that even though we are linking the Aadhaar bank account, your PAN card, everything you are going to be linking to your Aadhaar. So therefore, we are making more digitalization rather than physical banking system. Also, we can able to access through online banking. We can access our passbook. We can inquire our bank balance through phone call, through mobile banking, through online banking, through internet banking. We can able to access all the information whatever we are required. So any changes, we need not to be stand in the queue and need to be fulfill the operation. So instead of it, we can make use of the digitalized apps which are available in the particular banks, those are make us to more convenient towards doing the operations. So it has witnessed a transaction from the simple automation of paperwork in the bank branches to today branchless banking paradigms that use a new age of contactless technologies. So as I said, where through the digitalization you need not to visit the bank. So earlier we have everything is manually happen. So at the time, huge paperwork. As an individual, you must need to be visit the bank, and every transaction which is going to be recorded in the books manually. So, but today it is completely branchless, as well as it is a completely new age of contactless technology which we are going to be using. And people are increasingly enjoying the simplicity of managing all their finances in the one place, setting up an automated payment or making deposit. Today we can find there are deposit machines were there, and n number of ATMs are established by the individual bankers. Even whatever the deposit you are going to do, you need not to go for the bank, directly go for depository machine, and where you can able to place your currency to make transfer that currency into your bank balance, that you can able to do through the digitalization. Even by using your ATM cards, you can able to directly access, you can directly make a payment, or you can directly deposit the cash immediately rather than you are waiting in the queue. So these are the system. Even you can able to take the whatever the passbook entries are there, you just place your passbook in the particular machine, it will give you the updates with respect to the till the date, whatever the transaction which is happened, directly it will give you the printout of it. So therefore, instead of setting up an automatic payments or making deposits and anytime and anywhere without the need to queue in the bank. In future, bank employees will need to do the same. There is a paradigm shift from manual work to digital work, continuously development their skill to make sure that their career thrives. Job will not disappear, they will change. Our customer service reps may become holograms or artificial intelligence. So therefore, every banker, they are access the information by sitting somewhere else. So they are going to easily get to know what are all the total deposits today and what are all the payments they were made. So artificial intelligence, which is helpful to access the data from anywhere else and at any point of time. So therefore, it is very we can say that it is very unique way of process which every banker must need to be focused to make use of artificial intelligence towards make transparent system and easy to access the each and every data. But recruiting such employees who are working in the risk, compliance, big data and digital will be continue to accelerate. So in upcoming days, we can see that there are more demand with respect to the employees who are ready to work, ready to clean, are ready to show their excellence in the artificial intelligence. They have a very good future and exposure in the banking system. So therefore, whenever you are concentrating towards getting a bank jobs, better to concentrating on whatever the available artificial intelligence is there. You must need to be cope up with that, as well as you must need to be aware of whatever the banking system with respect to digitalization, mobile banking, online banking and technical knowledge, which is most important phenomenon, and recently it is more dominant in the particular banking system. And at the end, we also found that if you take an example of the Delight India point of view, following on from here touches upon the growth route of mergers and acquisition in India, a banking model in the form of making payments to the banks and innovation in banking, that is technology oriented, cognitive technology and artificial intelligence and blockchain technology and robotics process automation. These are the major impact nowadays we are expecting, and we are ensuring the greater extent of the performance by the bankers. So therefore, as a banker, you must need to be concentrate on all these factors towards empowering and enhancing the individual performance. Hope with this today we are completing the first unit, which is Introduction to Banking and Financial Services, where I am brief out what are all the things which we covered in the first module, where we are cover what is the central bank and what's their function, and what is the commercial banks and how they are functioning, and what is the Indian financial system with respect to scheduled bank, non-scheduled bank, organic and organized, unorganized sector, and financial institution, and what sort of the financial services they are providing, and evolution of the banking reforms, and measures of credit and credit control with respect to measuring the credit control system, where we are going to use the quantitative and qualitative tools. Also in the previous class, which we have discussed the financial reforms. So banking financial reforms, where we have discussed the 4 reforms, like how they are going to be given statutory regulations, which is must for each and every banker. And today we have discussed how as an investor or banker, they are focusing on providing the or considering the financial performance with respect to investing in the bank, or with respect to corporate mergers and acquisition. These sort of the decisions they are going to be make sure by understanding the financial performance. And also we are have a light on future of banking, where we are concentrating towards what are all the sector technologies are required, what is the paradigm shift which is happened from the past 2 decades, where every banker must need to be focused on these recent changes. They must need to be in the position to change themselves, because change is the permanent thing. Unless the bankers are not changed with the traditional system to current or modern techniques, obviously the banker does not have much survivability in the future. So hope everybody you understand and you get to know what is the importance of understanding the financial banking system and its concept and the structure of financial banking system. So I wish you all get to know the few information and in-depth analysis. So I expecting you to go through each and every key point, where it will going to give a high eyesight in the with respect to individual point. You can able to understand very well. So thanks for your listening. Thank you all.